Okay, hello everybody. Welcome to Korean Atlanta Mentorship. So I recently got a comment. Can you please stop with this whole cult leader BS? It is just uncool and weird. And then YouTube informed me today that your most liked video last week was click here and join the Velocity Banking cult. So I'm confused and put in a rock in a hard place. Am I gonna be cool or am I going to be a cult leader? I don't know, but why don't we just be cool for today? And here's the thing: I'm going to make a declaration, right? My declaration is if we study velocity banking after midnight, we're going to be cool because only cool people do that. In fact, I'm kind of half cool because there's another part of the equation where if you speak with the British voice and do velocity banking after midnight, that makes you really cool, according to the AI British voice bot. Let me go ahead and read this or play this.
Only cool people study velocity banking after midnight and speak with a British voice.
Yes, I'm only half cool. I don't speak with the British voice, but I am doing velocity banking after midnight. And maybe in the next video, I'm going to be uncool and be another cult leader because people really love that. So let's go ahead and get started. All right, let's do this. So why don't we review the classic velocity banking 10 credit card scenario. So if you don't know what that is, imagine if you're a really rich person. You make $9,321.45, and then after all expenses, you only have 1 penny left over. Now, here's where people get velocity banking wrong, okay? But let me go over to two requirements of velocity banking. Number one, you need a budget, which is obvious, right? Income, expenses, all of your debts, because this is a debt payoff strategy, and then your non-debts, which is your food, gas, insurance, all your general stuff that you have to pay off, that you have to pay even if your debt is gone. You always have to pay it. And then you need a line of credit as your main operating account. So here's the thing. A lot of people are like, well, if I just had a line of credit, then this would be easy, right? And this is where people screw up because let's say you were in this situation where you had a penny left over and somebody decided to give you a $200,000 line of credit. Now, why would a bank not lend you a $200,000 line of credit at this stage? Because banks don't lend money to people who need it. And if you only have a penny left over and you're like, oh my goodness, I need money, they know you're quite irresponsible with it. And this is what you're going to do. Oh my goodness, I have an emergency. I have an emergency. Let's say my car broke down. It's like going to cost me $3,000 in this line of credit. Well, guess what? That's an extra $50 payment. So let me go ahead and add an extra $50 payment at a minimum. And now we're at negative savings. Okay? So the line of credit didn't really help us. It just kind of made the situation worse, and that's why banks don't lend money to people who need it. Because if they, here's the thing: if you had known velocity banking and you were in this before you ever got to this situation, you would never be here. Hopefully that makes sense, but I don't know what I'm talking about because it's velocity banking after midnight, and I can't think straight. But at least I'm a cool kid. So we're going to assume we have this huge line of credit available, okay? And so that's kind of step number two, line of credit as our main operating account. And we assume two things, same income, zero savings, right? And then we're going to copy these expenses. We're going to copy all of them. And then we're just going to do income minus expenses to give us our cash flow number. But oh wait, we have to make our line of credit as our main operating account. So that's step two. Number one is the budget, and the step two is making our line of credit as our main operating account. So how do we make a penny into $5,340 something dollars and some change? Well, let's just transfer the balance of this line of credit. So if you sum this up, it's $167,000, $167,000 of credit card debt. Whoopsie, 000. Okay. And by simply doing a balance transfer, well, you're just transferring the balance, not like a credit card balance transfer, but you're basically transferring the balance of the credit cards into the line of credit. Guess what happens to here? That cash flow increases because all the credit cards go to zero. And so now we turned a penny into $5,345.84. Oh my goodness. Now here's the final step. Here's the actual velocity banking strategy. You put your paycheck into the line of credit and it satisfies the minimum monthly payment. And then number two, you take your expenses out of that line of credit. Expenses out of the line of credit, right? And then your cash flow is essentially going to be used to reduce the balance of that loan, right? That's what the cash flow does. And then you got to pay a little bit of change. Now, here's the thing, right? Don't get a first lien HELOC unless you do the math. Because every time I've done a first lien HELOC in these velocity banking simulations, because you may have heard in other velocity banking videos, go get a first lien HELOC or replace your mortgage and all your other debt with a first lien HELOC. You should do that, but the answer to that is always do the math. Now let's go ahead and do the velocity banking math. So we calculate the next month's previous month's plus one. To calculate the next month's balance, it's the previous month's balance plus the previous month's interest minus our cash flow. Our cash flow is 5345.84. And so now what we're going to do is take the average daily balance. Where's the average daily balance? Where's that formula right here? We'll blam average of these two numbers, multiply it by the interest rate, 0.09, and then divide by 12. All right, so I'm going to go ahead and copy and paste this. Let's go ahead and copy and paste this, and look at that. Wow, paid off in about, no, a little bit less than 3 years, because 36 months is 3 years. So let's go ahead and record that. So, and here's a cool thing, right? Let's say I had a $2,000 emergency here. So 16900, right? In the very beginning. Remember, if we had emergency, maybe a couple thousand in the average American way, we're negative $50 in savings. If we do this and have a $2,000 emergency, hey, our time frame payoff to pay off our debt, our $167,000 is the same. Isn't that mind-blowing? So now let's go ahead and do this. And I'm going to just put this as, not goals, it should be milestones. I don't know what I was doing. But that's because I'm a cool kid and I study velocity banking after midnight. But boy, am I sleepy. So 36 months. And I'm going to go ahead and copy and paste, right? And then now all we have is the mortgage. So let's check what the mortgage balance is. We have this really cool loan calculator here where all we got to do is fill in 3 terms, which is the balance, the original balance, the interest rate, and the loan term, and it'll spit out the payment amount. So this is from an old calculation. So let me re-update it. So this one's 350 at 3%. So 350000 at 3%. So 1475.61, right? And what month were we at? We're at month 36. So go to month 36. All right. And we paid 30 grand in interest after 3 years. And how much of the principal did we pay off? It's 350 minus 327. Oh man. Well, we paid a little bit more in interest than we did in principal, but again, that's a lot of interest. 30 grand for 3 years. That's like 10 grand a year, which I guess is not that bad if you really think about it, but it's still a lot. All right. So now what we do is we attack this mortgage. Now, what's really important is that we attack the mortgage last because the mortgage provides the least amount of cash flow for paying it off, right? We paid $327,000. We only get $1,475 back. Whereas if we attack these credit cards, like let's say even this credit card right here, this 35K, we're just thinking in terms of pure cash flow, even though interest rate does affect the cash flow or has a slight influence. Well, not slight. Two main factors: time and interest, right? Loan term and interest. But the higher the interest rate, the more it takes up the cash flow. Okay, so if I pay off this 35 grand, I got to pay about 1100 in cash flow. But if I pay this 300, like 10 times more, I almost pay the same cash flow. That's why we got to pay off according to what we call the cash flow index, right? And so if you have just one loan, like this isn't really that useful, right? One or two loans. But if you've segregated your income, which they warned you not to do, well, they warned you not to segregate. But here's the thing. You know what's funny? I feel like as a society, we've kind of gone backwards. Like I've been reading articles about how on college campuses these days, they openly encourage segregation and racism. Isn't that crazy? But here's the other thing too. They also encourage segregation of income, and they don't even say that out in the open. They just know you're going to do it from behavioral studies, right? You're going to segregate this income. I mean, take a look at this. I know I've shown this before, and this is one of the most like unicorn scenarios of segregation of income where you got income coming in and you have 20 something debts and it's like, whoa, where'd all that money go? Right? And with velocity banking, we're going to prevent the segregation of income by moving some of the mortgage principal into the line of credit. We could just use an amount like $10,000 into our line of credit and then paying it off with our cash flow. Segregation of income is a very important concept to understand. We don't want to segregate our income. Now, a lot of people were like, hey, man, if you have this extra $5,000, you could pay off directly in the mortgage. And I absolutely agree. I do. But who's going to do that? Right? Who's going to do that? Nobody. Or we would have a country full of people who had their loans paid off by about 7 to 10 years or the 30-year mortgages. You know what's crazy? Okay, you know what's really crazy? There's a card called Built MasterCard. Okay, it's a card that you pay your rent with. And the card essentially attracted a lot of people who are doing velocity banking without doing velocity banking because if you're paying your rent with the card, you're going to pay off the entire card because you're putting your entire paycheck in it. And I think it was Wells Fargo saying that they're losing 10 million a month on that Built Mastercard. So you might think about this: how the banking industry has no incentive for you to pay off your debt quickly. Okay, and they're like, yeah, sure, you can overpay a loan, but you're never going to get your money back, and that's why loans have lower interest rates because they're less of a risk if you cannot freely take your money back, right? I mean, think about it like this. It's like a Netflix account where it's the cheapest Netflix account, let's say 99 cents, but you can only watch from 1 a.m. to 6 a.m. because that's the lowest traffic time. Or you could buy maybe even like a 199 package and you can watch it all day. Maybe with ads or something like that. I don't know. I don't even have Netflix just because I don't think except for Squid Game and maybe what was that show Bank Heist in Spain? I think they had a Korean one too. TV's boring. Netflix is boring, and Netflix has an awful reputation of low quality movies. Anyways, all right. So let's get to this, okay? So let's say we move $10,000 of the principal into the line of credit. Let's go ahead and do that. So I move $10,000. Again, we only gain cash flow when the debt is completely paid off in the amortized loan, right? But let's move $10,000. Well, blam, paid off in 2 months. Okay? So if you take a look at this, so this is 350. How much is 350 minus 320? That's about 20 grand. Okay? About a little bit more than 20 grand, I think. Right. So a little bit more, about 23 grand. Okay, 23 grand I paid off, right? And it took me about 3 years, but here's the thing. I did 10 grand in 2 months. So about 6 months I paid off what would have taken me about 3 years. That's a wablam. Or a boom. Or whatever catchphrase we got to use. I probably need to copy the images of the Batman 60s show and kind of copy and paste those. But yeah, let's just use the velocity banking calculator just to kind of quickly estimate the debt payoff and then, oh boy, we can all go to sleep. But at least we're cool, right? I want to be cool. I was never cool in high school. No, I wasn't. But it's okay. I never really cared about being cool. But let's go ahead to the velocity banking calculator. Well, not this one. What am I doing? That's what happens when you're, uh, wait a minute. No, this is, oh my goodness. My brain not working today because because it is after midnight. All right, so now let's go to the velocity banking calculator. This is not it. Is this it? All right, there we go. There we go. Man. All right, so now let's go ahead and put in the original balance. which is 350, 350. All right, so 350,000. What's the current balance? It is 327,404.56. 327,404.56. And then the interest rate is 3%, and the payment amount is 1475.61. 1475.61. And then let's just kind of forget this chunking for now. But let me put in the income and the expenses. So what is the income, right? The income is $9,321.45. 9321.45. And then our living expenses is, what is it? 2,500. Okay. Now you might be asking, where did I get this really cool velocity banking calculator from? Well, I got it from Renatus, which is where I learned velocity banking in 2017, right? And full disclosure, I actually make commissions and sales off of selling their educational products. And so many people are like, where do I get this calculator? And I'm like, purchase Renatus. And they're like, no way. And they're like, okay. Well, people who don't pay attention, but again, whatever. Anyways, so let's go ahead and compare two scenarios. There's what we call, quote, chunking, meaning we just incrementally pay off the loan and chop it up into the little pieces and move it to the line of credit. So let's say in $10,000 chunks. Or we could do a full mortgage replacement, meaning this whole thing goes into another line of credit. Ooh, look at that. So if we do chunking, we only pay 23 grand and we save $127,000 of interest. Whereas if we do a full mortgage replacement, it seems like we pay a lot more, right? We don't save as much. Probably about, I don't know, 60 grand? I hope I did my math right. And some people, they don't even have the calculator. They're like, well, how's the calculator supposed to know you did a full replacement? Listen, the calculator is smart enough. It's almost like Excel AI, but before AI was even a thing, right? So let me just take a look here. It's like, oh, you got this loan of 327. Let's go ahead and replace it, and then it just knows that you've replaced it and you got that cash flow back. That's how crazy this thing is, right? So, oh, I'm so sleepy. But the point is, folks, I've never done, every time I've done a comparison of between a line of credit and I'm sorry, a loan replacement, first lien HELOC versus like doing this chunking thing. This chunking always wins unless the line of credit that replaces the loan is somehow lower interest, which is not possible unless like you're at like the 7 to 8% range. But if you have a 3% mortgage, very unlikely you'll find a 3% line of credit, maybe in the intro rates, but no. If you do find a 0 to 3% line of credit, give me a call, right? Because if you want to waste money, how much was that? So 69 grand versus 127 grand. So, yeah, about 60K, right? If you want to pay 60K more in interest, just give it to me. Just give it to me, right? And then you pay it off in about 4.3 years, and then we're good. And the cool thing is now we can really invest in real estate and not have to worry. So let's go back here to the demo and let's calculate the total payoff time. So 36 divided by 12 plus 4.3. That's 7.3 years. And we are completely debt free of $772,000 of debt. I think that's how it works. Or did I do this wrong? Is this the wrong spreadsheet? Oh boy. It probably is. How did I get 772,000? Something about this doesn't seem right. It's probably some other situation. So it's 350 plus 167. Oh, 500. Well, that's not bad. I mean, in the sense that 500 something is close to 700. So, all right. So Here's the other thing too. I hope that this now makes me cool and not weird. But in the next video, I'll probably be weird because I'm gonna pretend like I'm a velocity banking cult leader because I don't admit it. You know, like I said, I'm like O.J. Simpson. If I did do it, this is what I would say. Okay, well, that's it for today, everybody. So, if you're interested, and I probably need to actually make more videos about Renata since I'm trying to somewhat sell the product, but I was just kind of doing initial tests. Um, I don't want to say marketing. It's just I like to dip my toe in the water first and see what sticks. But one of the things that was noticing, and I think a lot of sales lead funnels experience this, and that's why you got to really dial down on who your dream customer is. A lot of people who waste my time. But if you're interested in learning a little bit more than velocity banking, click the Google form link below. And you can talk to me if you want, but I've made it so that I'm trying to discourage most people from applying because most people are not serious, right? Well, that's it for today. This is Korean Atlanta Mentorship. Have a great day, and we'll speak next time.